right, good morning, guys. Let's just get into it. So today we're going to just talk about what makes stocks move up or down. Now, I've listed some variables that play a huge factor, and there's a lot more than this, but I think this is just a good, starting point and things you should keep or be aware of and keep noted. So let's start. So essentially, everyone investing in the stock market is what gives the stock market its price. Also, people like, for example, Nike, Best Buy, Walmart, not only people investing in these companies, but also people going to these stores or returning things, or people that don't go to these stores. This also influences the market. So it's all of us as a whole. Now, what gives the current pricing of stocks? So we have something called the bid and the ask and the current price. The bid is the highest amount someone is willing to pay for a stock. The ask is the lowest amount someone is currently willing to accept for a stock. So let's say we have a stock that's $10, and then out of nowhere it jumped to $10.50. The asking price would have been the $10. The bid price would be the $10.50. The current price is the last price someone actually paid for that stock. So if you guys ever look at the stock market in real time, you'll see a bunch of numbers jumping up and down, and it's just a matter of, and it's funny because let's say you have 5 people, one person, everyone buying the same stock. Everyone tried to do it at different time intervals. Someone did it early as heck, woke up, they bought it at $10. Someone bought it at $10.30. Someone bought it at $10.40. Someone bought it at $10.01. That is possible. Someone bought it at $10.50. So the current price of the stock is basically the last price that the stock was sold, and that's why it's fluctuating up and down so much. Because the more people are investing into it, there's a higher volume being traded, the stock will go up, which is a very good thing for everyone. Less people are trading, that's not good. So just to reiterate, the bid is the highest amount someone is willing to pay for a stock. The ask is the lowest amount someone is currently willing to accept for a stock. And the current price is basically the last price someone actually bought that stock at. Now, it is a very time-sensitive matter. I mean, 1 second could be the difference between you buying a stock at $10 or $10.50 or even $11, You want to get the lowest amount, a stock for the lowest amount as possible, right? So you have more room for it to grow and, your profit margin gets higher. Now, I didn't write it up there, but something else that you want to look out for is a spread. A spread is basically the difference between the ask and the bid, or the bid and the ask. It's that in between. So let's say we have a stock that's only the bid is $10.50, the asking is 10. That's a very healthy spread because the numbers are so close together. But let's say you had a spread that was like the bid is $15 and the asking is, I don't know, $9. That's very wide. That is very wide. That's not a very healthy spread. You don't like that because that means that stock isn't selling very fast. And every time you sell a stock, essentially someone is buying a stock because there is a finite amount per company. And we covered that in a previous video. Every company doesn't have unlimited shares. Every company has a limited amount of how much they can have. Same thing goes for money. There is a limited amount of $1 bills, $20 bills, all these different denominations of currency. Same thing with stocks. So the spread is the in-between, the bid and the ask. Okay, a smaller spread is essentially healthier. So if we have a $15 bid and there's a $13 ask, that's decent. That means it's fluctuating between there. It's better when it's just maybe $1 or $2, $3 maximum, the difference. But if you're going with like higher end stocks that move like $50 every moment or go down $100, obviously you're going to see a wider spread, but that's very common for, those more expensive, like $1,000 stocks. There is stocks that are like $2,000 per share, $1,000 per share. It's very normal for these, but when you see stocks that are maybe in the, $300, $400, $500 range, and it's just a couple dollars difference between the bid and the ask, very typical. But if you have stocks that are like in the $100 range and below, and there's like a $50 gap between the ask and the bid, that's very bad. So you just want a couple dollars difference. So that's just what the current pricing is. Next, just like economics, stocks are a commodity. And we look at the whole, the rule of supply and demand. When supply is up, demand is low, the prices are down. When supply is down and demand is up, prices go up, right? So the supply in this case is the ownership or part ownership of a company, aka a stock. So the stock market does abide to these like simple rules of economics of supply and demand, and I just drew it out there in simple terms. Nothing very complicated about that. Next, world events can truly affect the stock market. When there's a country that has been hit by a hurricane, natural disasters, but a big one is war. I mean, think about it. When you have two countries at war with one another, not only are they at war, but also their allying neighbors or their neighbors, are also affected by this. Let's say there is, I don't know, what is it called? There's transportation between like a specific domestic, or international transportation company in one country, and because of war in this neighboring country, it's no longer for them to take these safe routes. So this will affect their business greatly, and we'll go back to this. It affect supply and demand. So war is a big contributing factor to. Let's look at Iraq and America. Oil, petroleum, that's a very big thing. You can, just like the stock market, you can invest in petroleum, or you can invest in their companies that own petroleum or mine it or whatever. You can even invest in companies that produce the equipment for these petroleum companies that they utilize. So it's a big game and everyone is involved in it, and war is a big contributing factor. Next, we have Donald Trump. And I make this as a 50% joke, 50% like kind of like honesty or truthfulness. Anytime Trump tweets something, he can fluctuate the market. I mean, when, for example, back, I don't know if it was 2017 or 18, his daughter had beef with Nordstrom. The president starts tweeting negative things about Nordstrom. It did affect their stock. And I know it sounds silly, but, politics, it should be no surprise, politics, senators, ambassadors, foreign affairs, anything affecting diplomacy, also going back to war, a president, a prime minister, what they have to say about something, who they have something to say about, a company or a country, these things do affect the stock market. The next thing that would affect the stock market is an economic crisis, aka a recession, unemployment, high unemployment, or a country that has a lot of debt, or people in the country that have a lot of debt, which in turn makes the country in debt, right? It doesn't help when the country's in debt and then the people in the country are in debt themselves. I mean, when was it? I think it was like within this right now it's 2019, but I don't know if it was 5 years ago or within 5 years ago, Greece got bankrupt, and I think for the second time, Germany bailed them out, and Greece actually prevented people, because a lot of people wanted to just cash out all their money because the country at this point in time needs as much money as they needed. The banks in Greece actually prevented people from pulling out too much money in a 24-hour period, and a lot of people got enraged by this because they just wanted to cash out all their money because they know it was about to come next. It's like a recession over there. I don't know if it's labeled as a third world country, but yeah, Greece had a serious problem, and Germany was luckily, the power over there, economic power in Europe, was able to bail them out again. I think it was the second time. Not too sure, but yeah, it was a very interesting thing to read. So things like that can affect your country, obviously the country, but affect the stock market internationally, globally, whatever you want to call it. Just because you have a lot of people that are not going to be spending money, or maybe there's people who invested a lot on properties or houses or something, a mortgage, in 2007, the whole housing crisis here in America, early 2000s with the bubble. You have a lot of people that are not spending money on things, people that paid too much on things and now they're in debt, and you have a bunch of banks that are have people indebted to them, and they got to also invest and pay money, but they can't because people are not paying them on time fast enough, or some people are just accepting their debt and not trying to do anything about it, rather just getting themselves into more debt. So things like this can affect the stock market. Wherever money goes, money's kind of like the blood of any business or the market or a country. It makes the world go round. Now the sun does. So opposite to an economic crisis, economic growth is another contributing factor to how the market can play. If you have a lot of people investing, making money, unemployment is at a very low rate, there's not that much taxes or whatever, or taxes are not like so bad, and you have people investing, you have people actually building, creating, giving this great progress in a country. Let's look at China. They're they have a very fast growing economy. Things like this, it does heavily affect the stock market. If for the better, obviously, opposed to an economic crisis. But yeah, economic growth is another contributing factor. It can make you or break you. Next, we have inflation, specifically the three types of inflation. The first one being demand pull inflation. This happens when the overall demand for goods or services increases faster than the production capacity of the economy. This situation leads to what is called a demand supply gap or a shortage, which results in, prices of things increasing. The next one, number 2, what we have is cost push inflation. Cost push inflation happens when there's an increase in the cost of production. When the prices of inputs or materials, labor, things like that increase, the production of the goods or services becomes more expensive, and the producers need a higher price to be profitable. An example of this is around summer. Avocados, actually not necessarily just summer, but avocados, they require a lot of labor, a lot of water, a lot of basically resources just to produce the avocados you and I get in the grocery market. And because it's so expensive to produce these little guys, it's very, it reflects on their price, why they're so pricey. Next, we have built-in inflation. This one happens, it's built-in inflation is caused by the expectations of future inflation, which means as prices rise, workers expect and demand higher wages to maintain their cost of living, right? However,
so lastly,
the higher the wages result in higher cost of production. So it's
interest rates.
It's just like a snowball
These
effect.
will cause
this
earnings
leads to
to
higher
fall
prices,
and stock prices to drop.
and then this
On the other
snowball
hand,
begins.
when interest rates have fallen significantly,
Now, in a nutshell,
businesses
inflation is basically described as the
spending
increase in overall
their own
price,
business,
level
causing
of
stock
goods,
prices
and
to
services
rise.
within an economy over a certain
interest rates
period
can
of
go
time.
both ways,
So
up
basically,
or
things
down,
are just getting
for the better,
expensive.
for the worse.
So
So
inflation
it's
has
something
a
to
big
factor,
contributing factor in the stock market. Aware of. The next thing would be taxes. Now, I'm not getting into the taxes of stock markets, but how it could affect how it moves up and down. If you hold a stock for let's say more than a year, you'll be taxed at a long-term capital gain rate. So your tax will be not that high. If you have a stock for less than a year, you will most likely pay your regular income taxes on the gains, because the profit you do make in the stock market is taxable. It is an income. It is some people actually live off of this stuff, or maybe partially live off of this stuff. So keep that in mind. The longer you hold stocks, the lower the taxes will be on that stock, right? Because let's say you bought 5 shares of Disneyland, or Disney, not Disneyland, but Disney, the business. You held it for more than a year. You can't get taxed the same for that specific year, right? Taxes change every year. They go up as everything else goes up. You can't be taxed the same time, at that same rate from that one day you did buy them. You'll get taxed at a lower rate in the future. If you held Disney stocks for let's say 5 weeks because you made some profit, you will be taxed regular income tax, or a regular income tax rate on those profits that you made. So these are just some things that affect the stock market, how it moves up and down. There is a lot more variables, but these are, some of the most notable ones, some that I think you guys should be, aware of. I hope this helped. I feel that I try not to make these videos too long, but I try to just explain, not go crazy into depth, just explain enough for everyone to get a gist of it. And we'll see you in the next video.